We'll get this legal disclaimer out of the way first. We at Luxo-Life are good at ferreting out good info for you all to enjoy. But while we all watch our own investments like a hawk, you should always consult your investment advisor before following any advice you find here or anywhere online. It's just good sense. We look for common and uncommon ideas we think you should be made aware of and present them so you can ask a professional licensed financial advisor. This is presented for your entertainment only. Now on with the video. Without a doubt, protecting wealth and assets is a primary concern for the world's top investors and billionaires. It may seem like paranoia or even an obsession, but it's rather economical. Whether bull or bear seasons take over the market, hedging around personal funds, investments, assets, and other liabilities is considered prudent. We live in an ever-changing world where the only thing constant is change itself. Situations similar to ones we've observed before may not always play along a predicted course, and so we're often left in uncertain times. The stock market is perhaps one of the best examples of this phenomenon of constant change. While there is a cycle of inflation and recession, one rule that applies to any investment medium and horizon is that past prices and performances do not guarantee how well a stock or fund will perform today and tomorrow, especially in the stock market where things can go south at any time and the bears are prowling around. So, what are the best things to do during bear market seasons? Welcome to Luxo-Life, your partner toward personal growth and success. Today, not only are we going to expose how preparation is key to surviving bear territory, but also what could be the best and safest haven during these times of uncertainty. A bear market or bear season simply refers to a declining stock market where selling stocks during a certain period is highly encouraged. This might be a great opportunity to invest in stocks that are selling for half the price, but you don't always get to the buyer. Sometimes you'd have to be the victim who got the short stick. So how should you prepare yourself for a coming bear market? Diversifying your portfolio is a tried and tested way of protecting your wealth. Holding various assets that carry portions of your wealth is a smart way of spreading and minimizing overall risks and keeping your capital safe. However, holding various assets may be substantial, but you're defeating the purpose of diversification if you put all your eggs in correlated funds. These funds are closely related, and they would often move in the same direction, meaning that if one goes down, the second follows, and so does the next. While correlated funds or correlated investments aren't exactly awful, you may want to diversify your portfolio by investing in negatively correlated securities. Negatively correlated investments are funds that can move opposite each other, like stocks and bonds. Often, we'd observe that when stock prices go down, bonds go up, and vice versa. While this may not always be the case, it happens because of changing interest rates. Naturally, interest rates affect both stocks and bonds, and when rates soar, stock prices and profits often go down, while bonds may expect higher future earnings. Therefore, investors would often turn to bonds with lower prices against higher interest rates and substantial long-term yields. Another good way of diversifying is by investing in uncorrelated securities, funds that move independently of each other and do not often affect each other's prices and yields. A good example of uncorrelated pairs is stocks and real estate investment trusts, or REITs. Here is a fun fact. REITs have outperformed S&P 500 stocks over the long term and have been observed to offer higher annualized returns from 1994 to 2021. Investors find REITs attractive because they're often less volatile than stocks and often provide steady income streams and dividends from various real estate assets and holdings. More so, billionaires like Warren Buffett find REITs a more convenient way of investing in real estate without having to put an active hand in real estate. However, it's not all sunshine and rainbows since REITs come with risks of their own, most of which are related to real estate properties. They can also be quite more expensive than your usual stocks, and as mentioned, historical returns don't always hold water against stormy times. All this is to emphasize the importance of diversification during bearish markets. You ought to make sure that you're diversifying the right way with inversely correlated and uncorrelated securities. That's one of the many reasons why the top 1% of investors remain strong and wealthy, because they are aware of the risks of having an imbalanced portfolio. If you're mostly invested in real estate, you might want to check out other investment funds and vehicles that can secure your assets and build your wealth over the long term. Bonds and REITs are good choices, but there's another more tangible form of investment that has been a reliable commodity and a good hedge against inflation for centuries: gold. Yes, that yellow mirror-like substance that kings, queens, and noblemen have coveted since ancient times and is still highly valued today. But wait, you don't always come across gold now, don't you? Well, unbelievable as it is, gold is much more accessible today to average investors, and you can even take one home from a precious metals dealer, a brokerage, or even a pawn shop. Interestingly, Sam Zell, the billionaire forefather of modern real estate investment trusts, had just recently purchased gold stocks for the first time. This is a 180-degree turn for the real estate mogul who criticized gold investments for decades. Now he calls it a good hedge against inflation. We all know that gold was once the highest form of currency when coins were made of them, but with modern government-issued currencies like darn paper money, cheap mineral coins, and digital credit with people-backed value attached to them, the bright yellow currency lost its place against the green stacks. However, it's certainly wrong to say that gold has lost its monetary value, because this rare earth element is still one of the most expensive commodities in the world. Back in the mid-1900s, an ounce of gold is only enough to buy you an average tailored suit. Today, you can buy 2 sets of Giorgio Armani two-piece for the same amount of gold. It's the law of supply and demand. The supply of gold shrinks over time as more and more smart investors own bullions, not billions of it, and because modern computer technology uses gold for motherboards, switch and relay contacts, solder joints, connecting wires, and connection strips. However, since gold isn't demanded as a common form of trade by the greater populace thanks to modern currencies and credit, it remains at a fair price. Hence why gold is unaffected by rising interest rates or bear markets, because its value heavily relies on its supply and demand order. Gold is neither correlated to stocks, bonds, or REITs. Therefore, it doesn't give investors the anxiety of thinking about its added risk to their portfolio. A few risks we can come up with for investing in gold are probably the expenses that come with storing the precious metals and perhaps the possibility of theft. Yet it has proven itself to be an effective store of value for hundreds of years. It mitigates portfolio risk, hedges against inflation, and sits as a reliable, high-value object that can be used immediately for any type of financial crisis that you got yourself into. We're seeing keep the family heirlooms and jewelry intact, and perhaps even get yourself a piece of the shiny thing, because you can pass it on to your children, grandchildren, great-grandchildren, and we can keep on going. The fact is, gold will definitely outlive you, and it's not just for the sake of having some bling and ding, but it's a multi-purpose, high-value resource that can benefit generations to come. But make sure that the gold you're buying is either physical gold or physical gold-backed one-to-one assets, not leveraged gold. Some gold that is leveraged 90 to 1 means that if some financial catastrophe happens, one person will get the physical gold and 89 will be left holding worthless paper. Bridgewater Associates, an American investment management company founded by Ray Dalio, holds $150 billion in investments. That is a lot of protection needed for a single firm. And Dalio uses gold to protect the company while encouraging all investors to hold 5% to 10% gold as a hedge. Other multi-billionaires like David Einhorn, John Paulson, and Paul Tudor Jones II have joined the bandwagon. Now you see what these smart money men have in common. They see gold as a weapon and haven that could protect them in any situation, thus making the purchase and investing for a diversified protected portfolio. A bear market is no joke, and once it comes, it will be risking lives. But it doesn't have to be so threatening if you know how to invest in gold. Want to learn more about these topics? Leave us a like and comment down below on what you'd like to know, and subscribe to the channel for more awesome and educational videos to help you on your path to success.